All right, everyone. And the topic today, I want to talk about bond valuation and determine if a bond is fairly valued or is it overvalued or is it undervalued. If it's undervalued, we can go into the market, buy the bond today, hold it until it appreciates at its maturity date, and make a decent return on our investment. If it's overvalued, we wouldn't touch it, right? It's too expensive. It makes no sense to invest in this type of security, right? So that's what we're going to take a look at today. Pretty straightforward, pretty simple type of analysis. So stick with me to the end. I think this video is going to be kind of short. And if you know just a little bit about bonds or know nothing about bonds, I think you're going to get a lot out of this. If you're a bond expert, you've been doing this stuff for the past 2 decades, I don't think you're going to learn a whole ton here. But anyway, let's proceed, and hopefully we can drop some knowledge and help to educate a couple of people out there. Okay, so bond valuation is basically done to help us understand the present value of future cash flows. These are coupon payments that the bond pays. These are guaranteed coupon payments, unless the bond, well, if it matures, you're not going to get any more payments, right, at maturity date, or if it's called away. Some bonds are callable, especially mortgage or corporates that have call features, they could be called away. But typically, you would get all those cash flows until the bond matures, right? And then you would get your principal back at the maturity date. So this is how it works. Basically, if you spend $1,000 on a bond that pays 5% interest, you would get $50 per year, or maybe two coupon payments every 6 months of $25 each until the maturity date. And that could be 10 years, 15, 20, whatever the maturity date is. And at the maturity date, you would get your $1,000 principal back. So it's a pretty good deal, actually. So you'd pay $1,000 today, get $1,000 when the bond matures, whatever date that is in the future. 10, 15, 20 years, could be 30 years, could be more. And then you would get the coupon payments every year, every 6 months. Semi-annual is pretty common, maybe quarterly. I've seen that before. That's somewhat less common. But it's a pretty good deal. You invest the money today, you get all your money back in the future. Now, in the future, your money's probably going to be worth less due to a few factors. Inflation, right? A dollar today is worth more than a dollar a year from now, because you can invest that money and make a capital return on that investment, right? And risk too. Like if you um, invest your money, you should be rewarded with some type of return, but there's always a risk to everything. You could lose some money too, right? So there's a few reasons why the time value of money is important, and why money today in your hand today is worth more than money in the future. Okay, so TVM, time value of money, is abbreviated TVM, and it helps us understand this concept. And then again, the coupons are the periodic interest payments that the bond issuer makes to the bond holder. So yourself and myself, as individuals or corporations, could be bond holders, and the issuer could be a bunch of different entities. It could be a corporation, Microsoft, Apple, um, any kind of publicly traded security. I don't think Microsoft has any debt right now. Some companies don't if they're cash rich. I think Amazon has no debt. I could be wrong. Microsoft, I think, has none. Apple does. We're going to look at an example of Apple in a couple of minutes. And the face value, the principal, is typically $1,000. That's very common. If you see something other than $1,000, that's pretty unusual. And obviously, like, that would be explained to you as the bond investor before you invest in that, right? But typically, it's going to be $1,000. There's only a handful of exceptions. So this was my data source. I've never used this thing before. Yesterday, I just discovered it yesterday. So let me show you how it works. So if we go over here and go to issuer name, I have some notes over here too. So issuer name equals Apple, up with that, and show results. Okay, you can just type it in here, show results. And we have our results. Now I am looking at a maturity date. This is already matured, 2023, 2029. That was 6 years ago. I want a maturity date that hasn't matured yet, right? Okay, so these bonds are basically gone. I'm looking a couple years out. It's 2025 now. I want something about 5 years out. And let me get something that rounds off nicely. I'll get 820, 2030. See that right there where my mouse is? 820, 2030. So it's about 5.5 years away from today. I think that's just a good place to start. This is totally random, guys. I'm just trying to introduce you to the topic. So we have the features of the bond here. Coupon rate, 1.25%. Maturity date, last trade price, last trade yield, last trade date. That was yesterday. Okay, so this bond is traded yesterday. Is it callable? Yes. So Apple issued this bond. They can call it back if a certain specific condition is met. I don't think they can call it at any time. I worked with these bonds years ago, but I forgot not all the nuances, but some of these nuances. I think a certain condition has to be met for the bond to be callable. They can't just call it at any given time willy-nilly. And then the next call date, oh, there it is. Okay, so in 5 years, it can be called, but between then and now, they cannot call back the bond. If it's called, it's basically redeemed by the issuer, so go back to Apple, and they would pay you whatever coupon payments are remaining at that point in time, and then you get the principal. You just get the principal back earlier, and you would miss out on some coupon payments along the way. That's all that means, okay? So I selected that bond just to get some basic information to feed into the model and to run it. So the face value is $1,000, almost without exception. We got this from the website, 1.25. The coupon payment is face times coupon, pretty simple. The yield, 4.633. Look at here, 4.637. You know, I actually got this yesterday. I think it changed just a little bit overnight. That's fine. So 4.637. I'll update that thing, okay? I did this yesterday. And that's 0.04, 0.04, let's just call it 4.6, okay? Because this is going to change every single day. So yield to maturity is 5.5. We know that. That's maturity date in mid 2030, and the last trade price was 83.43. 83.42. Okay, I got this data yesterday. I was tired at the end of the day, so I didn't make the video until today, the next morning, so it changed just a bit, 43.42. And by the way, if you see my other videos, I always try to make these very dynamic. So you just click the cell and run it, and it actually imports all the data from the website. That's called screen scraping. But when I tried to do this yesterday, I was getting some weird results from this FINRA website, and I couldn't quite figure it out. Normally I'm good at these things. I tried about 9 or 10 different approaches to getting this data imported dynamically, but I couldn't really do it. But I think it's fine. This is not a demo on screen scraping. I have several demos on how to do screen scraping on my channel. I put out a bunch of videos about that, so you can check that out. In this case, I don't think it's pertinent. All we're doing is understanding the value of the bond, and is it fairly valued, is it overvalued or undervalued? That's the point here. So if we can make it dynamically screen scrape, yeah, that's a bonus. That's the cherry on top. But I looked at it yesterday, spent a little effort, put in some labor, couldn't get it going, but that's fine. The point of this video is to analyze the inherent or intrinsic value of the bond. That's all we're doing here. So let me hit Control Enter, run it. You got my water. Okay, so the intrinsic value is $833.99. Okay, and the last trade price was $83.42. So what's going on here? There seems to be a big discrepancy between what the bond is trading at and the actual intrinsic value of the bond, right? So when it's redeemed, it's going to be worth $1,000. Okay, and we're about 5.5 years away. So this bond is trading at a deep discount, $83. It's actually like almost ripe for a 1,000% gain and value there, which sounds like a phenomenal deal, right? But remember, the bond is only paying 1.25%. So if you invest the money, you're only going to get $12.50 per year. That's not a whole lot of money, right? But again, that's a pretty good return, all things considered. You buy this bond for $83, you get 1.25% interest every year for the next 5.5 years. It probably pays semi-annual. I don't think the bond actually specified. We would need more data because I don't see it in here. Okay, here's the rating. So it's a AAA. It's issued by Apple, right? They're not going out of business. They can pretty much guarantee that. So it's actually a very good deal. You're buying this bond at a deep, deep, deep discount. It's not paying a whole lot of interest, but it's going to appreciate from $83 to $833. But actually, at the maturity date, it should be $1,000. So if you invest $83 today and you get back $1,000 in 5 years, that's a hell of a deal. It's probably a better deal than you're going to get in the stock market. You do have to wait 5.5 years, okay? So there's a cost of doing business here. You have to sit tight and wait 5.5 years. But if you could do that, the payoff is pretty huge. Okay, so the code calculates the intrinsic value of the bond, taking into account all the discounting and all that jazz, right? All the data comes from the link that I showed you. Okay, we tried to import it dynamically. It didn't really work. And after a while, I gave up because the point of the video is not to import bond data, but to calculate the intrinsic value of the bond and compare it to the market price of the bond. Now, if you buy it today, the price will appreciate. Like I told you, the total gain is about 916.57. And if you take this 1,000 minus 83, that is your total gain, right? So again, I don't want to belabor the issue here, but if you invest $83, you make $916. So that's pretty good bang for your buck. There's no question about it. I mean, like after I did the analysis yesterday, I'm seriously considering buying some of these Apple bonds and sitting tight for 5 years. And then you can calculate the total return would be about 1,092%. Again, this is slightly different because I did the analysis yesterday. Now it's 83.42. It only changed 1 penny. It's not a big deal, right? So again, coupon rate, but let's calculate the yield to maturity because this actually is the total gain that you would get, 1,092% in the stock market. That's a phenomenal return if you're getting that. That's great. But again, we have to annualize this. Like I said before, this is not 1 day, 1 week, or 1 month. This is 1 year. So we want to understand the yield to maturity, and this calculation will help us with that. So the yield to maturity is actually 64% per year. So again, still a heck of a deal. This is a heck of a good deal. I think when I finish the video, I'm going to go out and buy some of these Apple bonds because the payoff is pretty huge. Okay, so let us go ahead and plot this. I always like to say a picture is worth 1,000 words, right? If you illustrate the point here of what the code is doing, we can see clearly the intrinsic value is $833.99. Last trade price is $83.42. So this bond is seriously undervalued. This is a fantastic investment right here, okay? So just to wrap it up, why do we do all this? We want to understand market price versus intrinsic value. We accomplish that, okay? Risk return characteristics, okay? Investment strategy, investment decision making, okay? Mission accomplished there. Bond price sensitivity relative to interest rates. As interest rates increase, bond prices will decrease simply because a bond that's outstanding now will be paying the market rate of interest, whatever that is. If interest rates go up, bond prices have to go down because now new bonds that are being issued are being issued at a higher interest rate because the market rate is higher. Like you've seen this after COVID, the Fed raised interest rates significantly from, I don't even know, mortgage rates. I think were about 2.8 before COVID. Now it's like 7.5 to 8% for a mortgage. Depending where you live in the United States, and in other countries, it's going to be vastly different, right? I'm just thinking about the US. So it went from about 2.8 or so to 7.5 to 8. So interest rates went up a lot. All bonds that were issued around COVID or before COVID have depreciated in price significantly. That's a given. And if interest rates go down, bond prices will go up because now, if interest rates are going down, new bonds that are being issued at the current interest rate are paying a lower coupon payment. This is less desirable for investors. So the price will have to depreciate to make that investment more appealing. Otherwise, nobody's going to touch it, right? Because if interest rates are going down, I'm sorry, I misspeak. If interest rates go down, bond prices go up. There's always an inverse relationship. Interest rates up, bond prices down. Interest rates down, bond prices up. So we saw that happen during immediately after COVID in the last couple of years. Interest rates went up, bond prices went down. Now, if the Fed starts cutting rates because of the high inflation and trying to stimulate the economy, somewhat they could lower interest rates. Bonds that are existing today will appreciate in value because new bonds will be issued paying a lower interest rate. This is less desirable. So people are going to be more incentivized to buy the bonds that are paying higher interest rates that are issued previous to today, okay? And then to help us understand fixed income strategies. So that's pretty much it, guys. Hopefully you picked up a few nuggets of information there, trying to drop some knowledge on you guys. Hopefully that was beneficial. Okay, I think I'll wrap it up here and I will post the video later today. Thank you so much for your time. Have a wonderful day. Bye.